Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Welcome, everyone. Happy Monday. Getting into this final week of February. Got a really good show today. First, as always, we will talk econ. We've got Alex here with us. We'll talk about some current events as well. And then I'm headed to Dallas for a Housing Wire Economic Summit this week. So hope to see some of you there. And also today, we will talk through some of the topics that we're going to be riffing on in a session that I'm moderating towards the end of the day with some industry folks. So please do join us there for that.
Another big industry event going on this week is the Structured Finance Conference in Vegas. So there's thousands of people going to this one. It's really big for, back-end MBS investors, a lot of folks that value servicing, look at servicing, invest in servicing. So we've got some representatives there. So we'll definitely be interested in the mood at that conference, hear what people are saying, come out of that, because as we've covered on this podcast, everything that kind of happens there trickles down to front-end pricing and to originations. So see what takeaways they have from that.
That's right. Yeah, I'd be interested to hear what folks are saying about the next few years of MBS demand, right? Like you said, we talk about those spreads a lot on this podcast. With, Treasury rates probably not dropping over the next couple of years, that spread between treasuries and mortgage rates is really the only thing we can hope for to get smaller so that we get, mortgage rates more in the low sixes rather than the high sixes where we've been. Because, we've got the OBMMIs right around 6 3/4 right now for conventional 30. It's been stubbornly stuck in that spot. Still generally the lowest we've seen this year, but we haven't gone much lower than 6.7, 6.69. So,
yeah, still not enough for one of those even like mini refi booms that we've kind of been hinting at. We probably need, another eighth, if not more, just to even get a little bit of a refi wave from some of the recent originations.
Right. But seeing decent volume, volume's been healthy, still a bit above where we were this time last year. Although just demand in general is waning a little bit, it feels like, for homes. I was reading an article yesterday about that. Supply is starting to pick up a little bit at the same time. So might actually see some interesting moves in housing prices this year. All right, let's go check in with Alex, see what's going on in the world. All right, Jeff and Alex, let's talk a little bit about what is going on in the world. What did if I was hibernating last week, what did I miss?
Not a crazy amount last week. I think last week would have been a decent week to take a nap during. But looking at some of the housing specific metrics, we did get housing starts and building permits. Third week of the month is always focused on housing specific metrics. All of them fell kind of right around expectations. There really wasn't anything too market critical in regards to those housing specific releases, as you kind of alluded to, and I think we're going to talk about later, what the rest of the year looks like for the housing market. But as things stand right now, in a pretty decent position. Homebuilder confidence, which is interview and take a temperature test for home builders throughout the country. That one came in a little weak, landed at a 42 mark. Just looking at the past few years, the average in 2022 was 59 for that, then dropped to 44 in 2023, 45 last year. So far this year, it was 47 in January. So it's averaging so far this year, only 2 months in, but about where we were last year, which I think is kind of what a lot of people are saying about today's market is kind of expect a repeat of 2024 until there's some sort of catalyst that really propels this market in any direction, up or down. I would say if there was one thing to wake up for last week, it was definitely Friday's consumer sentiment numbers came in extremely weak. I think we were joking about this on the podcast maybe 2 weeks ago at the San Diego Forum. Someone had a graphic about how inflation expectations based on political party completely reversed in January. I can't imagine what might have triggered that. But this consumer sentiment reading reflected that as well. Republicans saw inflation dropping. Independents and Democrats generally saw it rising, which is the polar opposite of what we saw in December. That being said, what we are seeing in the economy right now from these consumer sentiment reports is the expectations for long run inflation are landing north of 3%. That's kind of been what I've been harping on during these econ updates is we've just seen that we saw that inflation metric stall out around 2.5% at the best last year when they started cutting rates. And then we've just kind of seen it tenths at a time tick back up towards 3% and even north of 3% for some metrics. That's definitely got me concerned a little bit about where the inflation picture is on the economy as a whole right now. And that release on Friday saw a pretty big sell-off in equity markets because of that, just seeing stalling in consumer expectations.
Yeah, that's so consumer sentiment down, home builder sentiment down. Some of that could be policy related too, especially with the home builders with steel tariffs and lumber tariffs. There's a little bit of posturing there, even potentially where builders are saying we're going to have problems going into this year if any of these tariffs take hold. And then, the consumer piece, hard to say whether that's heavily reliant upon what policy changes or if we really are just seeing things slow down and jobs are harder to get. And meanwhile, things are just continuing to get expensive at a relatively high pace.
Yeah, definitely. I think tariffs in regards to the home builder sentiment are absolutely one of the main concerns for these home builders going into this year with just those broad-based tariffs slapped on all imports. Steel and lumber prices. Most of that lumber comes from Canada, and they got tariffs slapped on them. So that's definitely a big concern for the finance departments at all these national home builders.
All right. So what's going on this week?
This week, I would say number one release is going to be that PCE metric. As we like to say, is that the Federal Reserve's preferred inflation metric. CPI and PPI are nice to look at, but PCE, which is inclusive of insurance rates and vouchers paid by the government, is what the Federal Reserve is going to be looking at their meetings. Of those three major inflation metrics, PCE has remained the lowest thus far. It's still got a 2 handle on it. That's about right around 2.5% last I checked. If we see this tick up towards 3%, I would say that gives us kind of a trifecta on all three inflation metrics, pointing towards higher inflation. That's coming out on Friday. It's expected at 2.4% this time around, but definitely keep an eye on that on Friday. Aside from that, I would just keep an eye on Federal Reserve speaking engagements. It's quite heavy this week. There's 9 of them in total, and 4 of them are from voting members. If you were going to tune into any of them, I'd definitely recommend tuning into the 4 that are the voting members, as they are the ones making policy decisions.
Yeah, I saw Austin Goolsbee spoke over the weekend, Chicago Fed president. He was saying, don't pay too much attention to one bad inflation number. We still haven't yet seen a trend that inflation is fully up. I think that's probably a more optimistic way of looking at it, but we'll see what type of language there is like that from the others in terms of how they're looking at inflation here.
Is it really just one bad number? I mean, we've started to trend higher. It feels like, or we've never really hit the right low number. We've been above 2.5% for 3 years, right? And then you can see it in the CME Fed Watch tool. Expectations for where rates are going to be over the next 12 months. We're starting to get to the point now where one cut is almost in question for the rest of this year, right? It's going to take some kind of, softening of the labor market, I suppose, to see rates go lower to give the Fed any kind of reason to cut. But for now, it just feels like inflation is heating up again, or at least it never got to an acceptable level.
Yeah, I concur, Jim. I think you saw it kind of trough out maybe Q3, early Q4 of last year when we were getting rate cuts. And since then, it's been continuous number of releases that have shown an uptick in inflation. Definitely nothing in rear view quite yet.
Right. Let's see. What else is going on? We had some somewhat troubling news about the FHA last week. So that's something that obviously is very close to our industry, is in our industry, where we might lose half of the employees of the Federal Housing Administration.
Yeah. I don't want to jump to too many conclusions quite yet. Yeah, we definitely saw last week on Wednesday, we started seeing reports hitting the ticker of the FHA's kind of next on the chopping block in regards to these federal job cuts. The number kind of hit in the ticker was somewhere between like 40 and 50% of the FHA could be laid off. That initial number has been kind of tempered back since that initial release that we saw on Wednesday. Anonymous sources at the FHA, all these sources are anonymous right now. They don't want to be singled out as someone, as a whistleblower of any sort. But what was told to CNN was that they're not expecting half the workforce to be cut. And with all of these, I think we've kind of seen a trend here, whether it be the CFPB, USAID. The headline shows, they're all losing their jobs, and then it gets tempered back to maybe 10%, and then it kind of falls somewhere in the middle so far. That seems to have been the experience thus far for the past month or so. So I would say just keep a pen in this one. Don't jump to any conclusions quite yet that the FHA is disappearing tomorrow. My one concern would be, and this was highlighted in a Housing Wire article, and I would tend to agree with this, that the existing cuts that have already been made, there's about 200 people who have left the FHA so far. Those are people cut due to the voluntary resignation program, or they were during their early probationary period and they weren't yet subject to civil servant protections. Those 200 people could create a workload imbalance that could result in a downward spiral and further voluntary resignations. So that I would say is, until we get a definitive number on some sort of workforce cut, that would be the main concern. That just workload concerns could lead to more voluntary resignations.
Yeah, you have to wonder what a lot of this, even just the news out there about cuts across the government and some of the, abrupt moves that have been made, what the effect is on morale, right, for federal employees right now.
Yeah, I definitely can't say I envy their position. Yeah, not knowing if you're going to have a job in a week, a month, or a year. That's definitely a scary situation to be in.
Yeah, that's a rough situation to be in. And yeah, you lose more people, and then you get into a spiral, right, where then the workload increases for everyone who's left, and then people start walking out the door at a much higher clip than maybe you normally see, whatever turnover looks like, for federal employees. Yeah,
absolutely. Yep. That like I said, that seems to be my main concern for the time being, would just be voluntary resignations.
Yeah. So practically, if that happened, some significant amount of layoffs happened for the FHFA. I think we saw some quotes, just what you would expect, right? Slower processing times, slower service response times, things like that. So certainly could have an direct effect on our industry and loan production.
Yep, that, or you could just see entire loan program types done away with as well.
Yikes. Yeah. All right. Good stuff, Alex. I think that was it for the week.
Yeah, I think that covers us for this week.
All right. Thanks a lot for the insight and for the wisdom.
Absolutely. Anytime.
Okay. So something we thought would be kind of cool to do every couple of months is to just kind of check in on what's going on in the world. What are expectations for the remaining part of the year? And what are some things we want to make sure we don't lose sight of, right? As originators, as lenders, as capital markets folks, just what are some things that we want to keep at the front of our brains and watch out for as we continue through this year? Maybe just the three of us too, just giving our opinions on where we see rates, where we see spreads and volume, and kind of, have our own ideas of what we should be focused on this year. So starting out with, and then what I plan to start off the panel with at the Housing Wire conference this week is, where are rates going to be this year, next year, year after that? If you ask almost anybody right now, we think rates are going to be flat, right? Relatively flat over the next couple of years, within a range between like 6 and 7%. I mean, you two have any opinions that fall outside of those bounds, or maybe a caveat?
No, I can't say that I do. Maybe if you're looking at the Fed Watch predictions right now, this might be a bold claim, but I'm going to say no rate cuts in 2025.
No rate cut.
You can message me in December when I'm completely wrong, but I'm going to go no rate cuts in 2025.
That is pretty bold if you look at the CME Fed Rate Watch. So I think it's about less than 10%. I think we will not have any rate cuts. Over 2/3 think we'll have 2 rate cuts this year, which I'm probably closer to your side, Alex. I really don't see that many rate cuts on the horizon. As we've kind of alluded to in different parts of this podcast already, there's just so many. When you think about rates in the middle, we're just being pulled in 5 or 6 different directions, depending on what you think about, particularly for mortgage rates. Jim, you were touching on, if the labor market continues to soften, or maybe starts to soften, then that could certainly be a cause to decrease rates. If obviously inflation's, the two big things being the labor market and inflation, but we're still at such a kind of if part of the conversation.
Yeah.
which way we're going to move.
Yeah, that's the big if, right? Like the big caveat. This narrative that I guess I've been peddling for the past year or so, which is the American consumer has borrowed too much money on credit cards. We've kind of ran out of runway for white collar jobs. Somehow that's going to feed into lower retail sales, worse employment situation, and so on. But it just has not materialized yet. And if it doesn't, there's really no reason for rates to get cut deep this year.
And that's, again, nothing has quite materialized, right? We're on like the precipice in terms of inflation. Inflation's running high, but not like that high, right? We, keep reading into every number we see, try to read into it in one direction or another. And it's just kind of sitting there, just on the, a little bit on the high side, right?
And it's all backwards looking as well. I mean, none of this is forward looking. This is all observed in the past. But to my argument of no rate cuts this year, the Fed, as proven last year, they need to see sustained decrease or halt in inflation before they make cuts. Considering recent releases have been trending upwards, they're going to need to see significant pullback in inflation and for that to be sustained, which I don't think they'd be comfortable. Even if the next report looks great, they're not going to be comfortable until at least September. And I'm not confident the next report will look great. So that's my argument. In addition to that, just the headwinds of tariffs on the economy.
And I guess the good news is there still seems to be some sort of natural cap on rates. Like even when these supposedly bad inflation numbers come out, like we saw, we sold off a little bit right after the number, but then we rallied right back. We're back to 6.7 after several, bad unemployment numbers or inflation numbers.
So let me ask one to you, Jim. Looking at, again, CME FedWatch, just solid indicator of what people are thinking. 25% of people think there's going to be a rate cut by May. Tell the story of how we have a rate cut in 6 weeks or in 8 weeks from now.
Yeah. To me, the only way would be next week's non-farm number is really terrible. We get close to the zero number, right? I keep guessing that we're going to hit zero at some point, right? You can see the trend lower. We're down into the hundreds now, the low hundreds. To me, that's the only way it happens. There won't be enough inflation data that comes out by then that's going to contradict everything we've seen for the past 7 months. I don't know. What do you all think? You think that's just dead money? the folks that have put futures on that there being a cut in the spring?
Yeah, 6 to 8 weeks from now, I agree. It'd have to be a out of the park in a bad way unemployment report or some sort of external catalyst, a COVID-like event, a bank failure type event, something like the economy needs juicing. Yeah,
that's always a possibility, right? And it feels like when we're all least expecting it is when something like that happens. And who knows where it comes from. Some people think there's another credit crisis coming, debt bubble, equity whatever,
bubble.
Right?
Yep. Yep.
Yeah, something like that could tamp down inflation too. If wealth suddenly evaporates, whether it's through, home values or more likely through investments, there could be an event that puts us in a situation where the economy needs stimulation. Needs to even an emergency cut could happen in that kind of scenario. So what does all this do for volume? Like that's really what people worry about in our industry, right? Is what's the volume going to look like this year? And if you ask the MBA, who always has really good realistic projections, we're going to see a 15% increase this year over last year, which seems very reasonable. And we're starting to see levels now in lock volume that we haven't seen since 2019 is about what we're seeing right now. It's obviously had some huge highs in 2021, and then even early half of 22, but now we're starting to see some volume that actually resembles where a normal market would be. And lenders are profitable at this point, at least 2/3 to 3/4 of them. So any kind of incremental increase in volume, if you don't have to hire significantly to manage that means a good year for the mortgage industry. It's not the binge that we saw during the pandemic, which I think we all know probably is never going to happen again, but it is healthy.
Yeah, good might be a little bit aggressive of a term. It would be an okay year. How about okay?
Yeah, decent,
yeah,
survivable.
Yeah,
survivable year.
Yeah, absolutely. Which is much better from where we were in 23. So a nice little growth over the past 12 months or so. But again, whereas volume, there's just so many moving parts. You talked about, home builder sentiment. We've been talking a lot about other things at play, such as insurance costs rising. We've talked about rates enough, but all those other things outside of just rates in terms of how it affects the borrower between taxes, insurance,
just
home
affordability.
prices.
Yeah. Affordability is just brutal still.
Yeah. So you can, all these things are being kind of pulled again in all these various directions. Which one has the biggest effect versus just kind of general borrower sentiment? We've talked a lot about borrowers are finally, realizing rates are going to be where they are. So they're finally being forced to move, or, just feeling like it is finally time for me to move, go buy a home.
Yeah. I think borrowers are comfortable with the rates, but throw another stick in the spokes and see what happens with it when it comes to like everything you just mentioned, Jeff. Yeah, whether it be insurance or home builder costs, whatever it may be. See how borrowers might react to that.
So that brings us back to policy, right? That's the other, I think the main things to watch as we go into 2025 is what is the new administration going to do, if anything, that's going to directly affect our industry, right? So there's the drama with the CFPB that's still out there. There's GSE reform, which we've talked about a few times on this podcast and on our webinars. Doesn't feel like anything is imminent there, but certainly would have an impact on spreads and impact on the market. Tariffs, we mentioned that on every single podcast, right? I think it's at the forefront of everyone's mind. Will tariffs continue to be used as a bargaining tool to bring other nations to the table to talk about other issues, such as immigration or fentanyl or whatever it may be? Or are we really going to tax our biggest trade partners 25% of every good that comes into the country? That's a pretty big open question that's still out there, where the lean tends to change, week to week.
Yeah. In terms of policy specific to our industry, obviously we talk about conservatorship a lot, and I just can't see any short to medium term path out of conservatorship. Jim, you had shared an article from KJ at Wells Fargo.
Mm-hmm.
One of the key takeaways I had from that was just don't underestimate the amount of infrastructure that Fannie and Freddie have put into place and are responsible for in the housing industry. And to think about starting to peel any of that back is just a huge mountain to climb, or making other people responsible for that type of infrastructure in any meaningful way. I don't see any path towards that, certainly this year.
And what do we get out of it? That's the other thing. Is it feels like, the administration is looking to make progress in a lot of different areas, whether it be cost of the government in general, or, agencies that have a direct effect on the consumer. But the GSEs, a lot of folks don't even know what the GSEs do if they're not in our industry, and what would taking them out of conservatorship do? It's likely not to lower rates. It's likely not going to create new loan programs. It's, potentially causes more competition over the long haul, but that would be the kind of far reaching impact of taking them out of conservatorship. So yeah, it does seem like a lot of work for what over the next few years in terms of the new administration, because no one thought we'd be here. No one thought we'd be more than 15 years out of the great financial crisis and still have the GSEs in conservatorship. Maybe it's just been too long. There's a million things to think about, but I think those are the big ones. A lot of it has to do with the administration. There's obviously the unemployment situation, which we've touched on here as well, and inflation. Those are really the things that we need to keep at the front of our brains as we go through this year, and we wonder where rates will be and how that will affect volume. All right. Thank you, Alex. Thank you, Jeff.
Thank you.
All right, let's wrap this thing up. Thank you so much, Alex. Thank you, Jeff. Anyone who's out there who's going to be headed to the Housing Wire Econ Summit, we'll see you in Dallas this week. And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thank you for tuning in to Optimal Insights.